Good morning. This is Ken Long from Tortoise Capital with a review of the daily trading plan for June 19th, 2011. Happy Father's Day edition. We are in a market that is sideways normal on a weekly RSI rating on a scale of 0 to 100. We're at 47, just below the midpoint. Using 10-day NDX, we're at 34 out of 100, or just barely out of oversold conditions. Percent stretch above the 200-day moving average is 1.70%, which puts us in sideways market conditions. Color-coded red indicating it's among the worst ratings that we've seen in the last 6 months. Same with the 50-day moving average slope. It's at minus 0.42%, which is bearish, and it's red. ADX 14 at 25.2 is a strong bullish trend, as you can see in the southwest corner. Minus DI continues to dominate over plus DI, and the trendiness has come up from below 15 to above 25 now, indicating a strong bearish trend. Looking at the ATR percentage at 1.33%, we're at the high end of normal. We're just on the boundary of going into volatile using that indicator. Looking at SPY's gap statistics, in the last 30 days, 15 times it has gapped down and 15 times it has gapped up. For those gap down days, it's continued to drop and close lower 8 times with an average follow through of minus 0.83%. When it is reversed up, it's improved on average 0.46%. So a clear vote to the downside on gap down days. In the 15 days that it's gapped up, 8 times it has reversed to close lower for an average of minus 0.43%, and 7 times the gap up has continued to close higher 0.37% of the time. The one standard deviation plus average move of SPY is 1.43%. That's the range stat. You can see a time series of the 10-day NDX with SPY. It's been oversold and now has just recently emerged out of oversold conditions. No signals on overreaction and channeling, and the pivot points you can see at 127.2 and SPY. 10-day max pain candidates: Alcoa, Cisco, Bank of America, Caterpillar, and Travelers, and the ETFs: natural gas, oil, metals and mining, oil again, and then the gold miners. We have a 551W in blended commodities. Channeling signals from energy, agriculture, and blended commodities, and among the large caps, Travelers, Intel, and ExxonMobil. Looking at the Dow 30 tactical summary, see the top 5 max pain range compression candidates, all looking favorable for a rebound or a further fail based on the small range of the previous day. A handful of dojis, 3 channeling signals, no other patterns of interest. McDonald's, you can see, being a relative strength winner from the last 3 months all the way up to Friday. Home Depot, AT&T, and Microsoft sort of fallen in that category, as well as recent strength winners. The big percent losers over multiple look-back periods, really at the top of the chart here with the max pain candidates, which make all of those interesting to me. Looking at the ETF 30 tactical summary in the same way: natural gas, Europe, oil, coal, and EFA, all max pain range compression. We have a handful of dojis as well. The channeling signals you can see, and we have in addition a 551W looking at DBC, the blended commodity. Frog candidates, this is a new addition to the chart pack for the daily this week, and I will speak more on that later, but just briefly, we're looking at, we're calling frogs as those targets that are likely to jump the furthest as measured by a multiple of their 30-day standard deviation of range. So essentially what we're looking at to classify frogs are this column here, where we take the range stat, which is the average range, plus a standard deviation. That gives us the range stat. If we then divide that back by the standard deviation again, this is the ratio between its maximum normal daily move and the variation of those moves. So if we look at utilities, we see a average range of the last 30 days being 33 cents, a standard deviation of 8 cents. Combine those into the range stat, that's 0.41. Divide that back by the range stat, and that gives us a ratio of 5.1. I think of that as the frog quality number, or how froggish it is on average. Alcoa, one of my favorites, has an average range of 40 cents, a standard deviation of 10 cents. With rounding error, that gives us a range stat of 0.51 divided by 10 with a ratio of 4.9, and so on. So these candidates that are highlighted in green turn out to be for the Dow 30 and the ETF 30, those whose range stat divided by the standard deviation puts them in the upper echelon of those two populations. In other words, it has to be 4.6 or better in order to be coded green. And then this column is sorted by their degree of frogginess. The methods and computations you see laid out there, I won't dwell on those. Our techniques are to trade these in a couple different ways. The slow frog is when we're waiting for the open plus 60 minutes to make a decision on which way it's moving, and then to buy in the direction of the indication of the daily move, using the standard deviation as our initial stop. The quick frog waits 30 minutes. The leapfrog is waiting to see a standard deviation move in either direction from the open, and combines a little bit of pattern analysis with candlesticks on the 3-minute charts and MACD histogram patterns to front run either the quick or the slow frog. And it trades throughout the day using a measure of standard deviation as the lens through which we look at those trades. So that's a quick look at the frog. And these are the frog candidates for Monday. Looking at the additional market mosaic indicators, the slope of the regression line is now almost 3 standard deviations below its average of the last 180 days. You can see the zoom in on the time series. The regression line is continuing to fall. The 10-day moving average of it, however, is closing a little bit. So the sell-off is slowing down just a little bit based on the regression line. And then you can see on the percent stretch, we've actually had from the swing high at 137, 1, 2, 3, a 4 standard deviation adverse move. It's resting right at -2 standard deviations, and we're very close to the 0 line. That's the dotted line. We're a percent or so above, 1.5% above that, which is the boundary right now for a sideways. We're in the sideways market, but going below the 0 line would be first indication of bearishness. Intraday range percentage stats and holding period stats for your review. Looking at the 30-day quality report in the Dow, I look for red and then improvement. So Chevron and Bank of America are both among the divergence leaders, going from red to not quite so bad. And you can see among the greens that have gotten that have stayed strong, really Kraft, Johnson & Johnson are the ones that have the current strength. But these other ones that are coated in red, you can see those are actually failing faster than the rest of the market around them. It's not unusual to see extreme behavior occur at extremes like this. Looking at ETF quality report, the same thing. I'm looking for red, and then followed by improvement. So you can see mixed commodities have actually gotten better, going from red to green as a color code, and blended or agricultural commodity going from red to white. So DBA and DBC look interesting. To me, up north here, only utilities have maintained their green status, green to green, and the amount that has failed, though, has given it a weak divergence. So again, from extreme conditions come extreme results. We'd be interested just on a divergence basis in natural gas, silver, and gold. More information on the gap statistics for those of you holding overnight and the Elder Safe Zone channel. SPY seems to be stabilizing here. Looking at the daily pivot points for multiple symbols. And looking at the alpha stat, or the comparison of the regression line of major indices and that of SPY. After we subtract SPY's regression line slope from each of these indices, this is what you have left, or the alpha of each of these sectors. We see the diamonds have made a conservative strength move compared to the rest of the U.S. indices that are now below the waterline here, below the zero line, which is SPY. The diamonds are the area of strength. Among the commodities, energy, gold, and blended commodities have all rolled over as they've started to give back this past week. Japan continues its relative improvement compared to the U.S. Euro-Asia starting to move, and emerging markets and ILF have all turned up. To me, that signals a potential turning point inside the tug-of-war between the U.S. and the globals. It may be time for the globals to exert themselves. No indications from the Elder Safe Zone. Top 15 winners and losers based on different time periods and an extended data set, looking at the top 200 most liquid ETFs, just as an idea of the range of potential moves that happen at the extremes, the correlation cross table. What's interesting here is EFA on a volatility summary. EFA has just gone to volatile at 1.87. You see it's exceeded its one standard deviation above average. So Euro-Asia blend has just gone volatile. That's the first index to do so. Gold, on the other hand, and blended commodities are all in the bottom segment. So gold has actually gone quiet, which is kind of interesting as well, with lack of volatility usually being a very good sign going forward for holders of the long position. So that's the daily summary, daily trading plan. This is Ken Long from Tortoise Capital. Keep your risk measured.